We look at life insurance and investment. Investments, when I look at one of my core philosophies, all money serves a purpose, but not all money is created equally. So, as an example, we're going to use the S&P, which is an index mutual fund. Okay? S&P, top 500 companies. I have diversification. Most people have heard of it. So now, if I invest in the S&P straight up, not in my retirement, not in life insurance, I'm buying a mutual fund.
Hmm.
So now, if I hold it less than a year, I'm going to wind up having to pay short-term capital gains, which is essentially ordinary income tax.
Okay.
Fine. If I hold it longer than a year, even if it's only 1 day longer, now I'm paying long-term capital gains. So my long-term capital gains, the percentage that I'm going to have to pay, the tax rate, is works parallel to my income. So I could pay as little as zero capital gains, or I could pay as much as 20% capital gains. Obviously, the more money I make, the higher capital gains bracket that I go.
Okay.
So now, if I get 10% return out of my S&P, now we're going to transition the S&P into my retirement account. When I invested in my S&P straight up, I was using after-tax money to buy my mutual fund.
Right.
The government's a funny animal. They tell us when you earn income, you got two options. You could pay me now, you could pay me later, but at some point, you're going to pay me the income tax. Fine. So now I put my S&P into my 401k, my 403b, my 457I, my IRA. I'm using pre-tax money to fund it. So I'm gaining access to more of my money quicker. So that's good. My money is growing tax deferred, right? I'm not having to pay taxes year over year. But then when I go to take the money out, when I reach retirement, now I got to pay taxes on everything.
Right.
You can pay me now, you can pay me later. Now, when it comes to my retirement, I have some things I got to keep in mind. Again, government's a funny animal. Don't touch your money too soon, prior to age 59 and a half, because if you do, we're going to hit you with a 10% early withdrawal penalty on top of your taxes.
Hmm.
Okay, anything else? Yeah, don't leave your money in too long. What do you mean? Minimum distribution requirement. I don't have to take all of my retirement money out, but whatever qualified money, meaning money that I haven't paid any taxes on yet, at age 73, now if I don't start to take the money out, at age 73, I probably have to take out about 4% of whatever I haven't paid any taxes on yet. Otherwise, they're going to hit me with a 25% penalty on top of my income tax. And oh, by the way, up until about late 2022-ish, that penalty was 50% penalty on top of my income tax.
Be still my heart.
Yeah, you would have to pluck mine out of my chest after it stopped beating at that point. However, now we have a third option. After tax money and growth of that money. You can pay me now, you can pay me later, or you can pay me never on the gains. When it comes to the taxes on the growth of your money, would you prefer to pay them now, later, or never?
Never.
Never. We got two options for never. One is a Roth platform for my retirement. 401k, SEP IRA, solo 401k, all of that stuff. Um, and what it tells me, unlike my traditional retirement, after tax money going in, money grows tax deferred. I pay no taxes on the gains in certain circumstances. Now, I'm
Okay.
prior to 59 and a half. I need to access some of my money. I can take out the principal, the money that I put in, no early withdrawal, and I already paid the taxes on it. My gains, the account has to have been open 5 years or longer, and I have to be after age 59 and a half, and then I can access my gains and not have to pay any taxes on them. And I have no minimum distribution requirement.
Okay.
Option two, I want to open up another IRA using a different funding mechanism.
Hmm.
I would transfer the funds out of one IRA to another IRA.
And you'd have to pay taxes on that. Okay.
Here, what's happening is when I'm accessing my money, I'm doing so in the form of a loan, typically at under 1% that I'm not required to pay back.
Okay.
So this was the concession that the wealthy people were like, look, I'd be willing to pay interest on a loan because debt is not taxable
Okay.
in lieu of paying taxes on the gains of my withdrawal. So now I'm accessing my money tax free. That would be great. You know, it'd be even better. What about if I could earn interest on the loan that I'm not required to pay back in lieu of paying taxes on the gains of my withdrawal? My money's performing in multiple places at one time. I'm kind of becoming my own bank. Okay, anything else? Yeah, if it happened to come with a death benefit, that'd be great. So 1988, Tamara Act comes out, and the government, like everything else that they do, screwed it all up. What do I mean? They didn't put any parameters on it. What do I mean? You had people taking out $100,000 life insurance policy and dumping like 200 grand a year into it. Now, most people's reaction is like, why would anybody put $200,000 into a life insurance policy?
Yeah.
Especially when the cash that I'm putting in is more than the death benefit itself.
Hmm.
You have to remember that it is not an investment that happens to come with life insurance. It's the life insurance that's allowing you to do all of these things with the money inside of it.
Okay.
So now, as far as the government was concerned, they were like, basically what I just said. They're like, not an investment that happens to come with life insurance. Life insurance allows for savings and or investments. If you want to dump hundreds of thousands of dollars, if you want to dump millions of dollars a year into this policy, you can, but you got to have a policy death benefit big enough to support the policy,
Okay.
to support the cash value. So now I take my S&P, which I got 10% performance because it's the same S&P, right? So if
Mhm.
I get 10% performance in the mutual fund itself, and I'm getting 10% performance in my retirement account, I may actually get better than 10% inside of my life insurance. Meanwhile, I can't lose money due to performance. So the insurance company absorbs all the loss, and then they give me the ability through something called a participation rate, where I can actually, instead of 10%, I could get credited 15% or 12 or 20. Meanwhile, they're not charging me any additional fees to protect me from loss and give me the opportunity for the additional return.
Okay.
So the distinction here is that we cannot call life insurance an investment. It is not an investment. It is life insurance that allows me to invest money, to put money into my policy and grow, kind of serving the same purpose as my investment, but it's taxed and treated totally different because of the life insurance.
Okay.